41%. Read that number again. 41% of the investors in Blue Owl Capital's $6 billion technology-focused private credit fund attempted to withdraw their money in a single quarter. Not 1%, not 5%, not even 20%. 41% of all the investors in that fund simultaneously decided they wanted out, that they had seen enough, that whatever the fund was paying them in yield was no longer sufficient compensation for holding an asset they could not access, whose underlying loans they could not see or verify, and whose value was being challenged by some of the most respected analysts in institutional finance. 41% ran for the exit at exactly the same moment, and Blue Owl told them no. Blue Owl told them, in a formal letter to shareholders, that they would receive 5%. Not 41%, 5. Which means that for every $100 that 41% of investors in that fund were desperate to withdraw in the first quarter of 2026, they received $12.20. The remaining $87.80 is still inside the fund, still invested in loans whose value is being openly questioned, still inaccessible, still earning whatever interest rate the fund reports it is earning on a set of more than 3,600 individual holdings in a structure that the Wall Street Journal described as a private credit black box that contains, inside it, more black boxes. This is not a footnote to the financial crisis of 2026. This is the financial crisis of 2026, right now. Happening to real people who put their real savings into a product sold to them with a specific promise. Professional grade returns, the same yields that the most sophisticated institutional investors earn, with the convenience of quarterly access to their capital. The promise of quarterly access was the entire value proposition that converted private credit from an institutional-only product into a retail phenomenon. $222 billion poured in from ordinary Americans, from retirement accounts, from family offices, from smaller institutions, all of whom were told that the quarterly redemption feature made this product liquid enough for their needs. And the first time, the very first real test of whether that promise was actually backed by the architecture of the product, not in theory, not in the fund documents, but in reality, the answer arrived in shareholder letters that are as clear as any financial document can be. You cannot have your money back. This video is going to show you the complete picture of what just happened, why it happened, who knew it would happen, what it means for every person whose money is currently gated inside these funds, and what every investor needs to understand about the structural features of private credit that the distribution machine selling these products never explained clearly enough. Not as a warning about the future, as a documented account of the present. The gates are already closed. The money is already locked. The question is not whether this is happening. The question is what happens next. Every number in this video is verified, sourced from Bloomberg's April 2nd report on Blue Owl's redemption caps, Fortune's private credit meltdown analysis published March 14th, Investment Executives' comprehensive private credit recap published April 14th, Hedgeco's BlackRock and Blue Owl gate activation analysis, Advisor Hub's Trapped Investors. Analysis published March 26th, Financial Content's Shadow Banking Crackup analysis from March 16th, the Perspective on Risk Substack analysis from April 11th, and current April 28th of 2026 verified market data. Let us start with the complete and specific accounting of exactly which funds have gated, by how much, and what it means in dollar terms for the investors currently trapped inside them. Blue Owl Capital's Blue Owl Credit Income Corporation, known as OCIC, is a $36 billion fund. In the first quarter of 2026, investors requested to withdraw 21.9% of the fund's shares. Blue Owl honored 5%. The remaining 16.9% of shares, representing approximately $6 billion in investor capital, is locked. Blue Owl's Blue Owl Technology Income Corporation, known as ALTIC, is a $6 billion fund focused on loans to technology companies. In the first quarter, investors requested to withdraw 40.7% of the fund's shares. Blue Owl honored 5%. The remaining 35.7%, representing approximately $2,142 million in investor capital, is locked. Total gated at Blue Owl, approximately $8,142 million. In the first quarter alone, according to Bloomberg's April 2nd reporting, Moody's Ratings downgraded its outlook for the OCIC fund from stable to negative on April 7th, citing the significantly higher requests from investors relative to industry peers, making this one of the few occasions in recent financial history where a major rating agency has formally downgraded a private credit vehicle in response to redemption pressure rather than credit losses. Apollo Global Management's Apollo Debt Solutions Fund holds approximately $25 billion in assets. Redemption requests in the first quarter of 2026 reached 11.2% of outstanding shares. Apollo honored 5%, approximately $730 million, representing 45% of the total amount requested. The remaining 55% of requests, approximately $895 million in a single quarter from a single fund, remains in queue. BlackRock's HPS Corporate Lending Fund holds approximately $26 billion. Investors sought to withdraw $1.2 billion, representing 9.3% of net asset value. BlackRock paid out $620 million, capping payouts at 5%. $680 million in requests remains unfulfilled. Morgan Stanley's North Haven Private Income Fund holds approximately $8 billion. Investors requested to withdraw 10.9% of shares. Morgan Stanley returned $169 million, approximately 45.8% of total requested withdrawals, capping at 5%. The remaining redemption requests are deferred. Ares Management's Ares Strategic Income Fund holds approximately $22 billion. Investors requested 11.6% of outstanding shares, the entire amount exceeding the 5% cap. Ares fulfilled 5%, approximately $525 million, representing 43.1% of the amount requested. Cliffwater's Corporate Lending Fund holds approximately $33 billion. Investors requested withdrawals that Cliffwater capped at 7%, which the firm described as a regulatory maximum, honoring approximately half of the total redemption requests received. The fund's founder and chief executive officer, Stephen Nesbitt, signed the letter to investors himself, a specific choice that reflects the institutional gravity of the decision. Blackstone's Blackstone Private Credit Fund, known as BCRED, holds approximately $82 billion in assets, making it the largest private credit fund in the world. Redemption requests totaled 7.9% of shares, or approximately $3.8 billion. Blackstone took the extraordinary step of injecting $400 million from its own capital and from investments by its senior executives to satisfy all of the requests, increasing its quarterly redemption threshold from 5% to 7% in order to do so. Total paid out, approximately $3.7 billion. Blackstone's decision to meet all requests rather than gate is the specific action that distinguishes it from its peers in this analysis, and it was made possible only by the extraordinary personal capital commitment from executives that most funds simply cannot replicate. In Canada, approximately $30 billion invested in private real estate funds, representing 40% of all such capital in the country, is currently gated as managers simultaneously limit distributions and halt redemptions. The aggregate picture from these documented figures: in the first quarter of 2026 alone, across the funds that have announced their tender results, more than $10 billion in investor capital made formal redemption requests. A significant portion was honored. A larger portion remains in queue, gated, inaccessible, trapped inside structures whose underlying assets were never designed to be sold on a quarterly schedule. Check. Verified. In the Bloomberg report, in the investment executive recap, in the Moody's downgrade, in the Advisor Hub analysis, in every shareholder letter that every firm sent when its gate closed. Now let us understand the specific structural mechanism that produced this outcome, because it is not a mystery, and it is not an accident, and it was not unpredictable. It was predicted, specifically and publicly, by every serious student of the private credit market's architecture. The prediction was ignored because the yields were too attractive and the fees were too large, and the distribution machine was too well funded for warnings to receive the hearing they deserved. Private credit, in its institutional form, operates on a simple and sound logic. A fund raises capital from investors, commits that capital for a fixed term of 5 to 7 years, deploys it into direct loans to middle market companies at interest rates above what the public bond markets offer, because the borrowers cannot access the public bond markets, and returns principal plus interest to investors at the end of the term. The investors accept illiquidity because they are compensated for it with premium yield. This is the actuarially sound version of private credit. The investors know they cannot exit early. They are compensated with returns that reflect that constraint. The semi-liquid private credit fund, the innovation that powered the retail explosion from $34 billion in 2021 to $222 billion by 2025, preserves the premium yield while appearing to soften the illiquidity constraint. It does this by offering quarterly redemptions capped at 5% of outstanding shares per quarter. This feature allows the fund to be sold to retail investors, to family offices, to smaller institutions, to the buyers who cannot commit capital for 5 to 7 years without any exit mechanism. The marketing materials describe this as the democratization of private credit, giving ordinary investors access to the same returns that pension funds and endowments earn with the convenience of quarterly access. But the mathematics of the 5% quarterly cap were always an insurance policy written against a specific and historically recurrent event: the simultaneous demand by a large fraction of investors to exit at the same time. The 5% cap was not designed to accommodate 41% simultaneous withdrawal requests. It was designed to accommodate the normal quarterly churn of investors who need liquidity for ordinary life events, a house purchase, a medical expense, a portfolio rebalancing. 5% is the volume of normal quarterly turnover in a stable fund. It is not a mechanism for crisis exit. And when sentiment toward an asset class turns negative simultaneously across its investor base, the normal quarterly turnover assumption collapses, and the gap between the exit demand and the available exit capacity becomes the specific measure of how many investors are trapped. The Fortune analysis, published March 14th, identified the specific nature of the retail investor behavior that produced the simultaneous exit demand. The regular folk drawn to these funds for their high yields proved far less patient than the super long-term holders that are the traditional pillars of private credit. The product was designed for institutional investors with decades-long time horizons who view illiquidity as a feature rather than a bug because the premium yield compensates them adequately. It was sold to retail investors who treated the quarterly redemption feature as a liquidity guarantee rather than a safety valve. When the product's performance came under question, the retail investor's instinct, conditioned by decades of public market investing where exiting a position is a matter of seconds, was to request redemption immediately and completely. The product's architecture had no mechanism to accommodate that instinct at scale. The Apollo co-president John Zito's statement at a UBS client meeting, reported by the Wall Street Journal, introduced the most alarming dimension of the current crisis. Zito said, with extraordinary candor for a senior executive at a fund in the middle of a redemption wave, that he literally thinks all the marks are wrong and predicted that a private credit loan to a generic small or mid-sized company might recover 20 to 40 cents on the dollar. 20 to 40 cents on loans that are currently carried on fund books at or near par, at or near 100 cents. The gap between 20 to 40 cents of real recovery value and the near par carrying value on fund NAV statements is not a rounding error. It is a valuation question that, if Zito is right, means the yields that investors have been receiving have been partially illusory, representing income earned on assets whose true market value is far below the stated portfolio value. The financial content analysis, published March 16th, identified the specific mechanism that makes the Zito assessment plausible rather than alarmist. JP Morgan took the unprecedented step in early March 2026 of preemptively devaluing software-related loans in response to artificial intelligence-driven valuation risks. Nearly 40% of some private credit portfolios consist of loans to software-as-a-service companies. As generative artificial intelligence has begun to commoditize the functions that these companies sell, the enterprise value that supports those loans has been declining. A company whose revenue is shrinking because its product is being replaced by an AI tool that costs a fraction of its subscription price has a diminished ability to service its debt. When enough of these companies simultaneously experience that revenue pressure, the loans that private credit funds originated to them begin to deteriorate. And the payment-in-kind mechanism, which allows borrowers to defer cash interest payments by adding the unpaid interest to the loan balance, masks that deterioration for precisely as long as it is in operation, producing the phantom income that near 10% of business development company total reported income represented as of early 2026. Now let us understand the specific concept of the liquidity mismatch, because this is the technical term that every investor in a private credit fund, whether currently gated or not, needs to understand completely before making any decision about their position. A liquidity mismatch occurs when the maturity of a fund's liabilities, meaning the time horizon on which investors can demand their capital back, is shorter than the maturity of the fund's assets, meaning the time horizon over which the loans will be repaid. The classic and catastrophic form of this mismatch was the savings and loan crisis. Institutions borrowed short-term deposits and lent them long-term as fixed-rate mortgages, and when short-term rates rose, the institutions were destroyed by the mismatch between what they owed depositors and what their assets were earning. Private credit's liquidity mismatch is less extreme in form, but identical in principle. The funds borrowed investor capital on a quarterly exit basis and deployed it into 5 to 7 year loans that cannot be sold immediately without accepting a significant price discount from their carrying value. The Hedgeco analysis confirmed the fundamental nature of this mismatch with a precision that bears repeating verbatim in spirit. Despite structural innovations, private credit remains fundamentally illiquid at its core. The timing of these developments is not coincidental. What was once considered a relatively insulated corner of the market is now being tested by real-world liquidity dynamics. Liquidity in private markets is conditional, not guaranteed. Conditional, not guaranteed. Those two words should appear in the disclosure documents of every semi-liquid private credit vehicle sold to every retail investor, in the same font size and visual prominence as the yield figure. They appear there in legal language, but they have not been the feature of the sales conversation the way the yield figure has been. The perspective on risk analysis from April 11th introduced a dimension of the crisis that goes beyond the immediate redemption problem and points toward the systemic implications. The author observed that the gating mechanism converts a catastrophic overnight run into a slow, painful grind. That is, simultaneously, the feature that prevents a 2028-style collapse and the condition that creates a multi-year process of value extraction from remaining investors as the funds are forced to sell their best assets first to fund the redemptions that they do honor. The mechanism of selling the most liquid, highest quality loans first to meet redemption demand leaves the remaining investors holding a portfolio that is progressively less liquid, progressively more concentrated in the loans that could not be sold, and progressively more weighted toward the borrowers whose credit quality makes their loans the least attractive to secondary market buyers. This is the specific dynamic that the Advisor Hub advisor described with painful clarity in a public comment. Private credit is the new subprime. Good loans will get sold for liquidity as close to par as possible, then the remaining investors will hold worse paper. For the investors who cannot exit now, who are behind the gate, their effective portfolio is going to become less representative of the fund's original quality over time as the good paper is sold to fund the exits of those ahead of them in the redemption queue. The gate does not freeze the portfolio in place. It selectively freezes the investors while the portfolio evolves toward lower quality. Now let us look at 3 historical episodes where the specific mechanism of gated illiquid investment vehicles trapping retail investors produced the outcomes that the current situation is replicating in structural terms, because the historical record is the most honest available guide to what happens next. The first historical episode is the Bear Stearns hedge fund collapse of June through July of 2007. The Bear Stearns high-grade structured credit fund and its companion enhanced leverage fund had approximately $1.6 billion in investor capital deployed into mortgage-backed securities. When those securities declined in value in the spring of 2007, investors requested redemptions. Bear Stearns halted redemptions in both funds on June 7th of 2007. At the time of the gate closure, the enhanced leverage fund was estimated to have suffered losses of approximately 90% of its value. Investors who had been receiving steady income from a product described as conservative and professional grade discovered, on the day the gate closed, that the fund's actual condition bore no resemblance to the performance statements they had been receiving. The parallel to 2026 is not in the asset class, which is different, but in the structural dynamic. Periodic liquidity vehicles investing in illiquid assets, reporting stable performance while underlying quality deteriorated until the redemption pressure exceeded the mechanism's capacity and the gate closed. The second historical episode is the United Kingdom Property Fund freezes of June and July of 2016 following the Brexit referendum. Major UK commercial property funds, including Standard Life Investments, Aviva, M&G, and others, simultaneously suspended redemptions in the weeks following the Brexit vote, as investor uncertainty about the UK commercial property market produced redemption requests that the funds could not meet without selling properties at fire sale prices. Approximately £18 billion in UK property fund assets was frozen at the peak of the gating wave. The funds were invested in actual physical properties that could not be sold in a matter of weeks at fair value, creating the identical liquidity mismatch that the private credit market is experiencing today. The specific lesson of the UK property fund freezes was that when the gate closes on a product sold with a periodic liquidity feature, the investors who did not get out before the closure discover simultaneously that their investment is illiquid, that the value they thought they owned is uncertain, and that the timeline for resolution is measured in months rather than weeks. The UK property funds began reopening approximately 3 to 6 months after the initial closures, as properties were sold and redemption queues were cleared. Not all properties sold at the values the funds had been carrying them at. Some investors received less than the fund's stated net asset value implied they should receive. The third historical episode is the most recent and most directly analogous, the Woodford Investment Management Fund suspension of June 3rd of 2019. Neil Woodford was one of the most celebrated fund managers in the United Kingdom, managing approximately £3.7 billion in his flagship Woodford Equity Income Fund. When a concentration of illiquid investments combined with poor performance and redemption pressure produced a situation where the fund could not meet investor exit requests, Woodford suspended the fund on June 3rd of 2019. The fund never reopened. It was liquidated over the following 18 months, with investors receiving distributions as assets were sold. The final distributions fell significantly short of the fund's last stated net asset value. Investors received less than they believed they owned. The gap between the stated net asset value and the realized liquidation value was the specific measure of how much the periodic liquidity feature had been overvalued relative to the underlying asset's true marketability. The Woodford parallel is the one that Zito's 20 to 40 cents recovery comment is most directly invoking. If the carrying values of private credit loans are wrong, as Zito explicitly stated, then the net asset values that investors see on their statements are wrong. And the difference between the stated NAV and the true liquidation value is precisely the loss that investors who cannot exit will eventually absorb when the loans mature, default, or are sold at market prices, rather than at the carrying values that fund accountants have been applying. Now, let us understand what every investor who is currently gated inside a private credit fund needs to understand about their specific options and the timeline they face. The first thing to understand is that the gate is not a default. The fund has not failed. The loans it holds are still being serviced by the borrowers, the vast majority of them. The 5.8% default rate that Fitch confirmed for U.S. private credit is elevated but not catastrophic. The 8% projected default rate for direct lending is concerning but survivable for a well-diversified portfolio. The gate is a liquidity event, not a solvency event. The distinction matters because it determines the recovery timeline. In a solvency event, recovery requires restructuring the fund's liabilities and potentially writing down its assets, which produces losses that may be permanent. In a liquidity event, recovery requires waiting for the assets to mature or be sold in an orderly way, which may produce a different level of return than investors expected, but does not necessarily produce the catastrophic losses that the Bear Stearns and Woodford episodes produced. The second thing to understand is the specific sequence of events that will determine how long the gate remains closed. The fund will continue to receive interest income from its performing loans. It will use a portion of that income to fund ongoing redemption payments to the investors in the redemption queue, honoring 5% of outstanding shares each quarter. The queue will clear slowly, quarter by quarter, as the eligible 5% per quarter is paid out and investors in the queue move forward toward the front. At current redemption request rates, the queue at Blue Owl's OCIC fund represents approximately 17 quarters of redemptions at the 5% per quarter rate, more than 4 years of waiting before all currently queued requests would be honored, assuming no new requests are added. That arithmetic is the specific timeline that investors behind the gate need to plan for. The third thing to understand is the payment-in-kind risk that the financial content and perspective on risk analyses identified as the early warning indicator investors should monitor. When a private credit fund's payment-in-kind income, the interest that borrowers add to their loan balance rather than paying in cash, rises above 10% of total reported income, it is a clear signal that hard defaults are on the horizon. PIK income is not cash in the fund's account. It is an accounting entry representing a promise to pay in the future from a borrower who cannot pay today. If PIK income is growing as a share of total income, the fund's cash generation is declining relative to its stated income, which means the fund has less cash to service its own redemption commitments, and more of its NAVA is composed of promises from borrowers rather than real cash flows. Investors with access to their fund's BDC filings, which are public documents for registered business development companies, can track this ratio directly. It is the single most important leading indicator of whether the gate's closure reflects a temporary liquidity adjustment or the beginning of a deeper deterioration in asset quality. The fourth thing to understand is what the secondary market offers. The J.P. Morgan initiative to build secondary markets in private credit assets, referenced in the perspective on risk analysis, creates a potential exit mechanism for investors who cannot wait through the redemption queue. Secondary funds, as David Firestein of Ronin Equity Partners told Fortune, may represent the winners of the current crisis because they can buy gated investors' fund interests at a discount, providing immediate liquidity to sellers and generating above-market returns for themselves by purchasing at below NAV prices. The discount at which secondary buyers will purchase gated private credit fund interests reflects their own assessment of the gap between stated NAV and true liquidation value. If secondary buyers are offering 75 to 85 cents on the dollar for gated fund interests, they are implying that the true value of those interests is lower than the fund's stated NAV by 15 to 25%. That discount is the market's best available estimate of the true cost of the liquidity premium that the 5% quarterly cap mechanism failed to provide. The fifth thing to understand is the regulatory and policy dimension that is developing in the background of the gating wave. The Trump administration's push to include private credit vehicles in 401k plans, referenced in the perspective on risk analysis, has created a specific political dimension to the gating crisis. When institutional investors lose access to gated private credit capital, it is a business story. When retirement account holders lose access to their 401k balances because a private credit fund has closed its gate, it becomes a political story with implications for the specific officials who approved the regulatory changes that allowed private credit into retirement accounts. The Securities and Exchange Commission and the Department of Labor are both monitoring the gating wave with specific attention to whether the disclosure practices of private credit funds adequately conveyed the liquidity risk that the current redemption wave has made visible. Regulatory action on private credit liquidity disclosure is more likely following the first quarter 2026 gating events than at any previous point in the asset class's history. Here's the complete picture of why major U.S. credit funds just blocked your money. Blue Owl's OCIC fund gated 21.9% redemption requests at 5% per quarter, leaving approximately $6 billion in investor capital locked. Blue Owl's OTIC fund gated 40.7% redemption requests at 5%, leaving approximately $2,142 million locked. Apollo's Debt Solutions Fund gated 11.2% requests at 5%, leaving approximately $895 million in unreturned requests. BlackRock's HPS Fund received 9.3% requests and honored 5%, leaving $680 million unfulfilled. Morgan Stanley's North Haven Fund received 10.9% requests and honored 5%, with remaining requests deferred. Ares received 11.6% requests and honored 5%, fulfilling 43.1% of requests. Cliffwater capped at 7%, honoring approximately half of requests. Blackstone met all requests only by injecting $400 million of executive personal capital. 40% of all Canadian private real estate fund capital, approximately $30 billion, is currently gated. Total industry first quarter 2026 redemption requests exceeded $10 billion with a significant fraction gated. Apollo's co-president John Zito explicitly stated, all the marks are wrong, and projected 20 to 40 cents on the dollar recovery for generic middle market loans. JP Morgan preemptively devalued software-related loans in response to AI-driven valuation risks. Nearly 40% of some private credit portfolios consist of loans to software companies whose revenue is being eroded by generative AI. Payment-in-kind income, approaching 10% of total reported income, is the specific warning signal of deteriorating cash generation. The 5% quarterly redemption cap converts a run into a slow, painful grind that could take 4+ years to clear at current Q levels for the most affected funds. Moody's downgraded Blue Owl OCIC's outlook to negative on April 7th, one of the few rating actions in history triggered by redemption pressure rather than credit losses. Over $265 billion in combined market value has been wiped from Blackstone, Apollo, Ares, KKR, and Blue Owl stocks from their peaks, including Blue Owl falling by 2/3. From their 18-month peak return period of mid-2023 through January 2025, Apollo fell 41%, Blackstone 46%, Ares and KKR 48% each. Goldman Sachs projects the retail private credit sector could shed $45 to $70 billion in assets over the next 2 years. The Fitch-confirmed U.S. private credit default rate of 5.8% is projected to rise toward 8% in direct lending. Private credit is the new subprime, in the words of an advisor quoted by Advisor Hub, because the best loans will be sold first to fund redemptions, leaving remaining investors with progressively worse paper. The gate is not the end of the story. It is the beginning of the chapter where investors find out what the product they bought actually is, at the price it actually has, with the liquidity it actually provides. For the investors who got out before the gate closed, the story ended with their returns intact. For the investors behind the gate, the story is still being written in quarterly redemption letters that tell them what fraction of their own money they are allowed to have back this quarter. For the investors who are still deciding whether to submit a redemption request, the specific information in this video is the information the distribution machine never provided in the sales presentation. Every piece of it is public, documented, and verified. The fund gate is closed. The money is inside. The timeline for getting it back is measured in years, not quarters. And the value it will have when it finally arrives depends on whether John Zito's 20 to 40 cents assessment is the exception or the rule in a portfolio that was always priced at par. If this video gave you the complete picture of why major U.S. credit funds blocked your money, assembled from verified sources with the precision that every affected investor deserves, subscribe right now, because this is the standard of analysis I deliver every single week without exception. The next video is going to show you the specific BDC filing indicators, PIK income ratios, and secondary market discount rates that allow investors in gated funds to assess the true current value of their locked capital before the official fund valuation process provides its own answer, along with the exact regulatory protections available to retail investors in non-traded business development companies whose funds have exceeded their redemption cap. That is the tactical guide that follows the structural diagnosis. Subscribe, turn on notifications, and watch it the moment it drops. The gates are closed. The information to navigate what comes next is available. This is it.